What up, pretty girls? Alright, so I'm gonna try and cover some shit real quick to where it's all publicly available information, but they don't exactly explain it to people the way they could in the most effective way, which is kind of funny, but that's how they do shit, you know. So they like to target investing information to people that already have money. What about people that have a bit of money coming in and they want to save it up somewhere? You know, they don't target that. They don't want to target that. And another thing is, there's no requirement for them to be accurate to tell you what you should and shouldn't invest in. Where I am, there's no paperwork required to call yourself a financial advisor. So just be advised that if people tell you, "Oh, I'm a financial advisor," you know, there's no paperwork that they have to show you to prove that, you know. So it's good enough for fucking internet, no? Okay, so I'm gonna cover dollar cost averaging. I'm gonna cover index investing and a little bit about mutual funds in general, and a little bit about tax-free savings accounts. So let's see. This is all stuff you can find yourself. It's public information. I'm going to focus mainly on this one fund here because it's the one fund available that covers what I'm about to talk to you about. So you would think, oh, there can't be much competition, it can't be that good, there's no competition. In reality, with an index fund, there's not much in the way of active management. It's a very passive management type of investment strategy. So the way it works, I'm going to get this going. Oh, and if you can't tell, if you didn't realize, if you didn't think about it, with the jacket, you know, and the fucking maple leaf flag thing here. Try to get all the wrinkles up, you know, whatever. We up in Canada. So if I say dollars, I'm probably talking Canadian dollars. If I'm talking about, you know, whatever, it's probably from a Canadian perspective. Alright, so index investing, generally speaking, we're talking about a mutual fund. Let's start with mutual funds. Mutual funds are where you put your money together with other people and then you buy some sort of security or investment, and that's the common element to calling it a mutual fund. But outside of that, they can be very, very different. It depends what the investment strategy is. So when it comes to money market funds, generally speaking, I've seen some referred to as money market funds that are actually bond funds, which is kind of weird. But a money market fund basically invests in treasury bills and things like that. And however many units you own, they calculate interest and pay you interest, typically monthly. Okay, so it's very similar to a bank account, except that you actually own an underlying security instead of having an account that a bank owes you money. So the difference is, for insurance purposes, you get $100,000 covered, typically for deposits against if the bank fails or something like that. Whereas with a money market fund, you own units, and those units own something. And if a money market fund fails, typically the payout's like 96%, 96 cents on the dollar. You know, with index funds, first you have to pick an index. In this case, it's going to be the S&P TSX Composite Index. It used to be called the TSE 300. Now it's called the S&P TSX Composite Index. So there's about 70% of the value of what's traded on the Toronto Stock Exchange is a part of this index. They aren't all a part of it. There's certain requirements. Stocks must be incorporated under Canadian laws. They have to be listed on the Toronto Stock Exchange, obviously. there has to be minimums to how much. How do I say this? There has to be minimums to how much transaction value there is, and minimum of, in this case here, a minimum weighted average price of at least $1 over the past 3 months, things like that. There's a lot of companies included in this index, but they're basically the ones that are making money, basically. Okay. The index itself is capitalization weighted, which means based on the value of the outstanding shares, so to speak. But also, according to some of the stuff I'm reading, it uses its float, shares that are readily available for trading, blah blah blah. It's basically shares that can be traded right away, and then you assign them all a percentage based on how much the market cap is, blah 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 blah. So if you put $100 into this fund I'm about to talk to you about, the percentage of each of the top 10 holdings, for example, RBC Royal Bank at 6.1%, Valiant Pharmaceuticals International Inc. common stock 5.7%, TD Bank 5.6%, Bank of Nova Scotia 4.2%, CNR 3.4%, Suncor 3.1%, Enbridge 2.7%, Bank of Montreal 2.7%, BCE Inc. 2.6%, and Manulife Financial Corp 2.4%. So if we do a quick add up, that's 10, 20, 30, so about 40%, almost $40, about $40 there is in the top 10 holdings out of your $100 if you were to put in $100. Now the mutual fund I'm looking at is called the TD Canadian Index Fund. Now it's basically the only one that does this. It's got holdings of about $1 billion. Let's see, it says 1,115 million, so 1.115 billion. And the price as I'm looking at this on the last business day was $21.76, so you can relate that to what the TSX is doing, but you don't have to, because these people do. Now the minimum buy-in, or the buy and sell, is $100. Now what that means is anybody with $100 could buy in, and anybody could sell out their shares, their units, at $100 at $100 increments. Okay, so that makes it accessible to people. Some of these funds out there, not index funds specifically, but some mutual funds, you have to have $100,000 for each transaction, things like that. That's all fine and well if you got it, but here's the thing: who are you selling to when you sell your units? Who's got 100 grand to buy? Okay, so think about that. So that's what the fund is here that I'm talking about. It's TDB, TD Bank, Tango Delta Bravo 216 is the code. You can look that up. And it's managed, so long story short, it's managed by TD Asset Management, TDAM, which is part of TD Group. So technically the fund owns pieces of itself, you know. Very low management fees. It's something like 0.8%. See, 0.88% as of June 30th of 2015. Now, if you do frequent trading, if you don't hold the share of the units long enough and you sell them all right away, you might pay a service fee or whatever, but that's normal. It's actually a good thing. So, if you want to buy individual stocks, you would have to buy hundreds of shares of all these different companies to try to match what these people are already doing, because they have an economy of scale. So if you can come up with $100 at a time, for this one I'm talking about, there's other strategies, other ways of doing this. You can buy in. Now, what did I say the price was? $21.76. So we can do a bunch of math here. We don't have to. But let's say the price was $25 and I put in $100. I'll get 4 shares, right? Let's say later on the price drops to 20. Okay, and I put in the same $100. I'll get 5 shares. So I really got 4.5 shares for each $100 I put in, even though technically the one time I only got 4 and the other time I got 5. So if you do this over a period of time, you're gonna have this is a purchasing strategy, by the way. If you've already got lots of money and you're selling out, that's another thing altogether. but you can do a similar strategy when you sell to sell in increments, not all at once, and sort of average out what you get back. What you're basically trying to do is lower your adjusted cost base. So if I put out $200 and got, let's say, 10 shares, then it's $20 a unit adjusted cost base. You know what I mean? It's just the amount of money you put in to get what you have. Okay, and hopefully that's a lot less than what the current value is. If it's not, it's a good time to buy. Otherwise, it's a good time to hold or sell. Now, when it comes to TFSAs, because there's a limit on how much money you can put in, this sort of a fund kind of works well with that, because you're only playing with $100 at a time if you want. You can put it in order for $100,000 at a time if you want, if you got it. But I think the maximum contribution room, if you've never contributed, is now $41,000 to a TFSA. So do you really want to be dumping that all into one thing all at once? That's like, let's say you had it, or if you're contributing it over a period of a year, a couple of years. And when it comes time to sell, the inverse thing is similar. If you denominate your sale in terms of units and the price drops, then you're only going to sell out the same number of units. If I say I want to sell 10 units and the price drops, I'll get less money, but I'll still only be losing those 10 units. Whereas if I denominate the trade in dollars, then it's going to automatically increase the number of shares I'm selling, or units that I'm selling, which is going to also have a negative effect on the adjusted cost base. Fuck. Incredible. So I don't have a fire. Yes, I do. Now, the distributions on this particular fund are mostly dividends, so they're already one of the lowest tax ways of receiving income is dividends. Interest income is charged more. So if you have lots of money, like well over 40,000, then you might want to only put in interest earning investments in your tax-free account, a bank account, money market funds, bonds, things like that. But if you have a lot less than $40,000, you can take advantage of the dollar cost averaging to build up the amount inside the account while minimizing the amount of money you put in. Similar strategies can apply to an RRSP, but you also, with the RRSP, you've got other things to consider, like, are you actually planning on retiring on that money, things like that. And you might not want to fuck around with mutual funds, stock funds, and things like that. Alright, so I basically covered the fund. I basically covered what's in the fund and how they calculate what it is. Those are details you don't need to pay attention to all the time. The nice thing with an index fund, at the end of every day, you get to see a number, that one simple number that everybody sees, and you can figure out approximately what your shit is worth. Okay, so I don't know what else to tell all y'all, man. We got another 90 seconds to kill. Another 90 minutes. Another 90 seconds to fill. What up, baby? Okay, so if you put small amounts in over a period of time, you can lower what it costs you, and if you make similar sales later on when the price is higher, when you can determine what your buy and sell prices are going to be. Let's say you buy in when it's at 20 and you sell at 25, then fucking you can have a very tax efficient strategy and a very efficient way of building up the capital value, which is not the same thing as income. Capital and income are different things. Okay, and the thing with this fund here is it pays out distributions once a year. Which would be, I guess that would be typical, either yearly or monthly. It's the only fund you can get for this. So ideally, you want to receive those payments in cash, because it might not be the best time to purchase just because you're getting paid all your dividends at one shot every year. You understand? So we go way more into detail on this in more videos. I guess I'm going to call this the introduction. Okay? So